And I think we are live on Facebook. Let me just check that out to make sure we are good to go. So bear with me 1 second, everybody. I think we are live. The joys uh, of technology. So thank you everyone for joining us today. Today's session is going to be on how to avoid mistakes while filing your corporate tax return. I am just give me 1 second. Confirming we are live on Facebook as well as our different channels. And it should be. Sorry, guys. Internet's behaving quirky today. And we are live. Okay. Thankfully. Okay. Sorry about the delay, everyone. As I said, my name is Andrew Wall. I'll be hosting your session today on how to avoid mistakes while filing your corporate tax return. A little bit of background for those of you who aren't familiar with us. CPA 4ID is an accounting firm specializing in independent contractors. We've been doing that since 1984, when my father, George Wall, founded the original accounting firm, Wall & Associates Professional Corporation. We're also a member of the National Association of Computer Consulting Businesses, which is sort of like a lobby group for IT consultants. And we're also fortunate to have won a number of awards in the technical space, from top cloud accountants to accounting influencers, to a whole bunch of amazing awards. But really what we're here for is to help our clients organize their finances, create wealth, and transform wealth into a legacy. And today's webinar is again designed around helping you organize your finances, which will help you to create wealth and transform that wealth into a legacy. So first, let's start with the importance of accurate corporate tax filing. So the number one reason you want to look at making sure that you are avoiding mistakes with your corporate tax return is avoiding the dreaded CRA audit. And we've got a great seminar on top 10 strategies to reduce audit risk. I encourage you guys to go back in and check some of our past webinars to have a look at those. But CRA has really increased a lot of its focus on CRA audits. And with those obviously come the appropriate or the corresponding tax penalties, which we're also trying to avoid. And then on the positive side, we're also trying to maximize the tax savings. By avoiding these common mistakes, you're going to maximize the amount of tax deductions and minimize the amount of taxes that you're going to pay, and obviously maximize the tax savings. And then avoiding interests on any unpaid taxes that go along with those audits and penalties. So we want to avoid those wherever we can. So let's start with the most common mistake. So the most common mistake is not reporting all of your earnings. So this is the number one thing that CRA is looking for, is unreported revenue, whether that be, interest income, rental income, contract income, or any other income generated by the business. One of the most common things that can get overlooked is reimbursed expenses. When it comes to reimbursed expenses, some people will go the route of not including the revenue and then not including the corresponding expense. And the problem with that is that if CRA comes down the road and says, hey, we found this revenue, you haven't reported it, and you say, oh, but these expenses, and they then disallow the ITCs on the expense or disallow the expense in general, it could be problematic for you as far as interest and penalties are concerned. So our recommendation there has always been to report your reimbursed expenses as revenue, have the corresponding reimbursed expense item, which then nets down to zero. So there's no tax impact, but we have the audit trail to report all of the revenue, because this is one thing that CRA takes very, very seriously. and they will use you as an example if you're not reporting all of your income. The second most common mistake is not actually tracking your revenue and expense data on a monthly basis. A lot of people will leave their taxes to the last minute. It's like going to the dentist. It's not something that people, enjoy doing. And so as a result, they often defer dealing with this. What I can tell you is that the longer you defer this, the more difficult that you make it for yourself. It's a lot easier to go through and do your bank reconciliations and keep your information up to date and accurate, because if it's recent, you're going to remember what those transactions are. If you wait till the end of the year, you may not remember what that purchase from Walmart was, whether it was a business expense or a personal expense. So going through and processing your information on a regular basis, at the very least on a quarterly basis, is the way that we'd recommend doing it. And the great news is that there's a lot of amazing technology to make this process far easier than it was. So you're not looking at having to keep track of this in a physical log anymore. You can leverage technology like QuickBooks Online, Xero, Dex, or even our CRED manual. And our CRED manual, which stands for Capturing Revenue and Expense Data, is a Excel spreadsheet designed for some of our simpler clients, to allow you to just keep track of your revenue and expense is in a simple spreadsheet. But again, if you can get in the monthly habit of recording all your transactions, it will make the process a lot easier for you. And this will, again, help you to stay on track so that you can stay on time, so that you can avoid late filing and the corresponding interest and penalties that go along with it. And what we do see time and time again is people will say, I'll leave it till the end of the year because I'm busy now. And then the end of the year comes and, your work gets busy, the family gets busy. There's a million and one reasons that you get distracted from doing a job that, let's face it, most people don't enjoy. And then next thing you know, they're late. And then because they're late, it makes them want to put it off even more. And then what turns into a month late turns into 3 months late, 6 months. And now, we've seen clients where we're doing 5-6 years in catch up, and you're dealing with interest and penalties with all of that, which is a problem in itself, but you also might run into issues where things are statute barred and you're no longer able to claim input tax credits on GST and HST and those types of things. Another common mistake is not keeping receipts or bookkeeping records. A lot of people also believe that a credit card statement is a valid frame of reference, or a bank statement is a valid frame of reference as far as documentation for revenue and expenses. And unfortunately, that is not true. The government is within their rights to deny an expense that you do not have a transaction record from the vendor. And specifically what they're looking for are things like the GST, HST number if they're Canadian, the line item detail, because you can imagine that if you have a receipt from Walmart, which is a great example, or Amazon, it could be for business supplies or it could be for personal supplies. So the government likes to see the line item transaction detail. And there are situations where people have been able to support an audit without the original documentation. But even in the most common case, which I reference all the time, which was a guy had gone through a divorce and his ex-partner had taken all his belongings, put them on the lawn and lit them on fire. Even though there was a police report for that and the client was able to prove that the records had been maliciously destroyed, the CRA did give them a percentage of the deductions they claimed, but they didn't give them 100% of those. If you really want to maximize those deductions, you want to be able to have receipts and records for every single expense item that you are processing. You also want to have it in a way that's really easy to retrieve, because if you go through an audit, you don't want to spend hours trying to retrieve that information. And that's where tools like Dext or Expensify can come into play. Now, Keeper has a new tool that's come out that also does the same thing. And what these tools allow you to do is to take your mobile phone, or a scanner, take a picture of that receipt, upload it. It will then use OCR technology to recognize the information that is on that receipt, including the date, the vendor, the line item detail, the tax, and then either put that into a spreadsheet for you or to export it to something like QuickBooks Online or Xero. These technologies, unfortunately, are not free, but they pay for themselves in the time savings that you're going to get in your bookkeeping, as well as if you go through an audit. And typically what will happen in an audit is the CRA will come in, they'll look at a couple of categories, and they'll say, I want to see your 10 largest expense receipts for these categories. And if you can't produce them, they're going to dig deeper. So if you go through an audit, you really want to be able to make sure that you can provide the receipts and bookkeeping records for every transaction that you are recording in your books. And again, technology is your friend here. You can leverage things like Dext. And even if you aren't going to pay for a software like Dext, please, 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 please get in the habit of taking a picture of every single receipt that you have with your mobile phone, because that can be loaded in down the road into a software like Dext. But if you don't have them in digital format, odds of you going through piles of paper, number one, it's just going to be too overwhelming and too time consuming for you to do. And number two, if you're not aware of this, many receipts are printed on a special type of paper called thermal paper, which means that if you go to look at this receipt down the road and that receipt has been exposed to heat, whether that's sitting on your dash or by a heater, those receipts will be unreadable. And even you can get that sometimes just by putting it in your pocket and getting crinkled. We've all seen those receipts that are hard to read. But if you get in the habit of taking a picture when you spend the money, so if you go to Starbucks and you order a coffee, you can have taken the picture before you even receive your coffee, and now you have a permanent digital record that you can use to support an audit or to do your bookkeeping. And so, like I said, your phone is your friend here. Leverage that technology, create the habit. And the hardest part there is to actually create the habit. And what I recommend to people is that you put a reminder in your calendar for a month or 2 months that every single day at 11 o'clock or whatever day you normally, take a break, to remind yourself to take a picture of any purchases that you've made that day. That will help getting you in the habit. And then once you've gotten in the habit, and they usually say it takes, 11 to 15 attempts at doing something before you actually start to begin to form the habit. But once you form that habit, it will become second nature to you. And every time that you make a purchase, you'll find yourself pulling out your phone without even thinking about it. So that's my number one recommendation for those keeping receipts and bookkeeping records, is to get technology on your side with your mobile phone and potentially with a software like Dext or Expensify or Keeper to help you OCR those transactions. Another common mistake is to not register for sales tax. So there is a requirement that once you've made over $30,000 a year in sales tax, you must register for HST. Now, if you're under $30,000 a year, you do not have to register for GST, HST. However, we do recommend for our clients that you sign up for an HST account as soon as you can. And that's because you can actually make money on GST, HST. So if we take an IT consultant here in Ontario as an example, if they elect for the quick method of HST, they're collecting 13%. But on the first 30,000, they actually only have to pay the government 7.8% of that. And they get to keep the delta between the 13% they collected and the 7.8% that they have to pay the government. Now, on anything over 30,000, it's actually 8.8%. Or you can calculate it, simpler method if you're over 30,000 is 8.8 minus 300, because 1% of 30,000 is going to be $300. So you're looking at about 8.8% that you're able to keep. So allowing you to keep about 4.2% of your revenue in what they call sundry income. Now, in order to do this, you do have to register for the quick method of HST. By default, you are on the long method of HST, and you're usually also on quarterly filing. So if this is your first year, I highly recommend that you look into that. Now, there are some caveats here. If your revenue is not subject to HST, you could have an exempt client, or you could have a client that's based out of the US where you're not charging HST. Then the quick method isn't going to be better for you, because 7.8% of zero is zero. But if you take the long method, zero minus your input tax credits, which is what you've spent on your expenses that have HST on them, will become a negative, and a negative is a refund. Now, we do have our first question that's already come through, so let me take a look here. Is collecting PST in BC mandatory even if you don't provide any legal services? So PST, I'm assuming by legal services you mean services that are subject to PST, because PST is provincial sales tax. A lot of provinces are harmonized, which is HST, harmonized sales tax, which is provincial sales tax, plus the federal sales tax. But if you're not providing services that are subject to PST, you do not need to register and collect PST. But again, you may wish to, because if you are using the long method, again, if your revenue is not subject to PST, but you've paid PST on expenses, you can have zero minus the PST that you paid as an input tax credit and get a refund. So no, you wouldn't be required to, but again, I'd probably recommend it so that you can claim those input tax credits. And where were we? So let's go back to our presentation here. And yes, you do need to register and collect PST in any applicable provinces where you have services that are subject to PST. And so you would want to look at your specific business, whether it's subject to PST or in Quebec, QST, which is a whole nother issue and nightmare. But we'll leave that one for now. You do want to make sure that you're remitting and collecting sales tax, obviously, regularly to CRA. Even if you're on the annual method, what will happen is after your first year, you're going to be required to make quarterly remittances based off your previous year. There is a caveat that if the amount of installments that have been calculated based on your previous years is less than what you actually owe based off of your true business activities, you can change your remittance method. However, if you get to the end of the year and you owe, the CRA will charge you interest from the installment period if you've miscalculated. So another common mistake is not having a separate business bank account. So first of all, you cannot deposit checks written to your business name to a personal bank account. If that happens, it's a mistake that's been made by your bank. Banks, checks written to your business have to be deposited in your business. But in addition to not having a separate business bank account, I would also incorporate with this not having a separate business credit card. A lot of people will use a personal credit card for business expenses. And, we can sort of work around that, but there are a lot of potential issues there. First and foremost, if you have any fees with that credit card, CRA could deny that expense because it's not under the business name. We could argue that it was used solely for business, but now you're into a point of having to argue something rather than it just being approved. In addition, it makes your bookkeeping far easier. So the best practice is to have a corporate bank account and a corporate credit card, put all your business expenses on the corporate credit card, and all your personal expenses on your personal credit cards. If you're not sure whether something is business or personal, we would recommend putting it on the corporate credit card, because we can certainly back out personal items that have been put on a corporate credit card. And we're going to then have that audit trail of every transaction that's going through there. But you don't want to be in the habit of mixing everything together all the time, because it's going to make your bookkeeping more difficult because you have more transactions to deal with. And it's just going to complicate things substantially. Does look like, I think we got another question here already. Does this require going back to clients to collect PST if you haven't done so previously? Yes and no. One option is to effectively net out the sales tax. You basically have to assume, like if you've broken the 30,000 threshold, you are required to remit PST. So in a worst case scenario, you would have to effectively say that that total included the PST, and you'd have to back it out accordingly. But many clients will have no problem paying you the back PST as long as you're registered, because it will be an input tax credit for them. For most large businesses, they're not going to qualify for the quick method because you have to be under $400,000 a year in revenue. And that means they're on the long method, and the long method is calculated by what you collected in sales tax less what you've paid in sales tax. So if they're paying you out the sales tax, it's just reducing the amount of sales tax that they'll pay the government. So they usually don't have a problem doing that. And you can also backdate a registration for sales tax, but you'll have to demonstrate to the government that you were actually had revenue and you should have been registered for sales tax, and they will backdate it for you. So I hope that answers that question. So yeah, getting back to mistake number 5, not having a separate business bank account or business credit card. Obviously, the bank account is a requirement for depositing any revenue. But we have seen, situations where people have, received cash and then deposit that into the personal account, and that is very, very problematic for a lot of reasons. And again, having the, corporate credit card is a best practice to make sure that you can maintain and keep any expenses related to that credit card. Any charges or fees for that card can be deductible, as well as creating a clear audit trail for your transactions. Mistake number 6 is not leveraging all the available deductions. In today's webinar, we're not necessarily going to be going through a list of all of the expenses that you can claim. You can find an example of some of the most common expenses here, as well as with a more detailed explanation on our website under cpa4it.ca/expenses. The big thing I want everyone to be aware of when it comes to expenses is that this is not an exhaustive list. This is meant to be, to help you understand what are the main things that most people do claim. When it comes to deductible expenses, there are three rules that you need to be aware of. First and foremost, it can't be specifically disallowed by the Income Tax Act. The good news for you is that even though the Income Tax Act is a very lengthy document, there's not that many things that are specifically disallowed by the Income Tax Act. But there are a few things. First and most commonly that a lot of people are aware of is golf green fees. So those are specifically disallowed. You can claim, food and beverage at a golf course, but you can't claim golf green fees. So if you're going out with a group of people, you want to make sure that they pick up the green fees and you pick up the beers on the 19th hole or whatever the case might be. Club memberships are also specifically disallowed. So that includes golf clubs, country clubs, yacht clubs, gym clubs and memberships. Those are unfortunately specifically disallowed, so you can't claim those. As well as your home telephone line. Now, very few people actually have a home landline in this day and age. Most people just have a cell phone, and a cell phone is perfectly deductible. But if you have a landline and then you only have one line for your home, that would be specifically disallowed. It is considered a basic necessity, and you cannot claim that in your business. You could claim a dedicated business line, all the additional services, call waiting, long distance, those types of things, voicemail, but the base landline is specifically disallowed. There's also some specific rules around life insurance. Again, life insurance gets a little bit complicated if you're looking into getting life insurance. Again, we got some great webinars with our partners, IT360. I encourage you to go check those out. And if you're looking at getting insurance, make sure you talk to a professional before doing it. but life insurance is specifically disallowed. But it does also have a special thing that says that we can record it as a line item on the tax return, but then add it back. And what that means is effectively you're able to pay for the life insurance with money that's been taxed at the corporate rate, as opposed to money that you would have to take out of the corporation, pay personal tax on, and then pay with money that's been taxed at the personal rate, which is typically higher than the corporate rate. But if it's not specifically disallowed by the Income Tax Act, there are two other criteria you need to be aware of. One, it has to be reasonable, which by definition is subjective. What's reasonable to you is different from what's reasonable to me, which is different from what's reasonable to an auditor. We believe that the person who knows best as to what is reasonable is yourself. And when it comes to a deductible business expense, if you can demonstrate it's not specifically disallowed and you can demonstrate that in your opinion it's reasonable, and that it meets the third criteria, which is also that it has the ability to help your business earn income in the future, which again is subjective, then you can claim that expense. Now, if CRA disagrees with whether it's reasonable or has the ability to earn income, help your business earn income, they could deny the expense, but they can't hit you with a penalty. So I want you to think about everything that you spend money on in your life and think about sitting across the table from an auditor and being able to come up with a justifiable reason why this will help your business earn income and why it's a reasonable expense. And if you've got that, then you can claim those expenses as long as it's not disallowed by the Income Tax Act. And like I said, here are the most common things that you can claim, which include our fees, advertising expenses, which might include gifts or large events like a New Year's party. You've got your automobile expense, which could be mileage based or actual. You could have your bank charges, which could include those credit card fees if you've got a corporate credit card, books and periodicals, business promotion, which is usually meals and entertainment. Now, with business promotion, they do add back about 50% of that. You report it at 100% to us. We'll worry about that add back. You could have computer leases, computer hardware, which would fall under capital assets, computer supplies, consulting fees, amortization, which is the portion of those assets like computer hardware that we can claim each year. Not going to bother getting into the definition of assets and amortization in this session. Again, we've got great past webinars that do go over those. Education and seminars, which we strongly encourage people to make sure that they're doing, because if you're not expanding your knowledge base and you're not growing, you're hindering your ability to continue to generate income in the future. Employee benefits, which is always going to be the CPP plus any other benefit packages that you might have. General expenses for those categories where there's sort of a mixed bag of things, you're not sure where to put them. Insurance expense, which would include things like errors and omissions, health and dental, and potentially if you do have some of these other insurance expenses that we would add back, like life insurance or potentially disability or any of those other ones, which again, go watch our seminars on insurance. There's we can do a whole hour just on that. Directors, well, this says directors advances, it should actually be directors fees. These are typically the salaries paid to the directors. Interest and penalties, office supplies, professional fees, which is usually like incorporation costs or legal fees or anything like that. Rent expense, which is most commonly your home office, or if you actually do have an actual office that you rent. Repairs and maintenance. This is the repairs and maintenance that is 100% deductible, dedicated to the office space itself. If you have a home office and you're doing a repair and maintenance to the home office, we'll take a percentage of that, and that goes under the home office rent expense category. And we do have a special worksheet for our clients that you would complete for any of our existing clients who are familiar with that. Telephone, which would include telephone and internet, travel expenses, and then wages and salaries for other people who are non-arm's length, non-directors. The travel expense is a great one. This is an area where there is quite a bit of opportunity here. And what I would say is if you're ever considering a vacation, if you can tie it into a conference so that we can guarantee at least the airfare and at least a portion of the hotel is deductible, that's a great way to make lifestyle expenses, deductible business expenses, but you can also look at investment opportunities. You can look at exploring business opportunities, a number of great ways to make travel legitimately deductible. Another common thing that people mess up on is not keeping an automobile log. And this is really important right now because it is the number one most audited expense category. And that's because someone at CRA has figured out that most people are not keeping a mileage log. And so when they audit these and you can't produce the mileage log, they disallow the expense. And a lot of people can't be bothered to go back and recreate the mileage log. And this is where a mileage tracker can really help you. Mileage trackers are amazing new pieces of technology that allow you to just swipe left or swipe right, whether it's business or personal, and it's going to keep track of all the mileage for you automatically, just based off of your GPS tracker in your phone. If you do have a QuickBooks Online subscription, that is included with your QuickBooks Online subscription. You just need to download the app and turn on the feature. If you don't use QuickBooks Online, there are other mileage trackers like MileIQ, and there's other ones out there. There's ones that you can get with OBD sensors that plug into your phone or plug into your car. There's a number of ways that you can do this without having to, track every single day. I drove from here to there and it was to meet with this person. We do have another question that's come through. Is the director's advance for shareholders or all the directors of the corporation? So we had a bit of a typo on that previous slide. So let me explain the difference between director's advance and director's fees, because this can often become confusing. Director's advances is a balance sheet item that tracks all of the money that has been loaned to the director. So typically what a lot of our clients will do is instead of doing a monthly payroll, they will only take out of the corporation what they need as they need it. And so instead of calling this a salary, we will call this a loan or an advance, a director's advance from the corporation to the director. And at the end of the year, we'll look at what the balance of this director's advances are. And based on that, we will declare a salary, which will be your director's fees. A lot of times what you'll see under the director's fees expense is the tax planning for all what I call arm's length people. So all family members, if you're doing any income splitting with your spouse, your children, your parents, anything like that, typically all falls under the director's fees expense. In some situations, if you are paying monthly salaries to family members or to arm's length individuals, those will be reported separately under wages. From a tax perspective, there is no difference between those two categories. It's more from a tracking perspective from us going through and analyzing, okay, this is salary that we're declaring based on annual bonuses versus this is salary that we're paying out on a monthly basis. And again, this is the standard chart of accounts that we use. These tie back to something called a GIFI code, which is how the numbers that you see on your income statement flow through to your T2, which is your corporate tax return. So one of the things that a lot of people don't realize is that a financial statement is actually a presentation for the business owner, and it's meant to help you have clarity and understanding. And it translates different to the tax return itself, which is the T2, which uses something called GIFI codes to take the information from the income statements, which include a profit and loss as well as a balance sheet, and then flow that over to the corresponding line items on the tax return. So I hope I'm not going too deep there for you, but I hope I've also answered that question. So mileage tracking, really critical because it is the number one audited thing right now. And a lot of people are losing their deductions because they're not keeping track of those. Another common thing is claiming personal expenses, which can increase your audit risk with CRA, obviously. And it can lead to potential reassessments and tax penalties. So typically if CRA comes along and they reassess something and you have, one, you don't have the documentation, or two, they think that you have been egregious, in your classification of deductible business expenses, they will typically dig deeper. Now, the one thing is, if you're unsure, I would encourage you to report it. We will do an analysis. We will do a benchmarking analysis, show you how you compare to the average and the median. And my personal belief is I'd rather take a crack at claiming the expense and have CRA come back and disallow the expense. But if you know definitively that you can't claim something, like if you're trying to claim baby's diapers, you know, you don't want to do stuff like that. You know, we've seen people try to claim their pets, you know, as security, you know, animals or other things, and you know, you tend to just get yourself into more hot water than the benefit that you're receiving out of the few additional deductions. But if you're unsure, put it through. Let us run our benchmarking analysis and show you how you compare to the average, and show you if we think that, you know, you're at risk for, you know, potentially disallowed deductions or excessively aggressive interpretations of personal expenses. This is a big one that we see time and time again, is not paying installments. Again, if your business has changed and your net income from a corporate tax perspective has decreased, or your gross income from a sales tax perspective has decreased, you can reduce your payments. But if you end up owing at the end of the year, they are going to charge you interest from the date of that installment. And you don't want to do that. Why give the government any more money that you need to? This says you can incur interest and penalties for late payments. Interest, yes, on installments, not penalties on installments, but penalties certainly on late filings. And those can be from the installment dates if you owed from those installment dates. Also, you know, it can disrupt cash flow. If you get to the end of the year and you just don't have the money set aside, that becomes problematic of itself. And then it's really just a missed opportunity from a better financial planning perspective, and having budgets and making sure you have appropriate money set aside and all those things. And we have potential legal consequences for non-compliance. I haven't really seen anyone sued over this in my experience, but potentially that is a liability as well. And the other thing is just not only not paying your installments, but getting to the end of the year and not having enough money to pay your tax liabilities. Obviously there's, you know, your cash flow issues. You've got penalties and interest for all these late payments. The stress and uncertainty is another big factor. And, you know, can really compromise the business operations by having to divert funds that you would want for running and operating your business. So this is really something that I always recommend to clients, is because a lot of our clients will come from full-time employment, where historically they've had all their taxes withheld at source and remitted to the government on their behalf. So they're not used to like getting to the end of the year and having to pay taxes. So I say, if you set aside 30 cents for every dollar that you earn, you should have more than enough to pay your taxes, and then have a little bit of a slush fund at the end of the year. Looks like we've got another question that's come through here. Something coming through on our YouTube channel. Should the loan from the business account to personal need to be put back at the anniversary date? And if not, then should it be considered a director's advance, if not put back in the business? So the director's advance, you can potentially put the money back in the business and not have to then declare it as a director's fees. However, there's a big caveat here. There's something called a series of loans and repayments. If you're taking out money at the beginning of the year and then returning at the end of the year, and you're doing this repeatedly, the government will call this a series of loans and repayments, and then deem that to be a director's advance and then a director's fees correspondingly. So this is not something that you play a game with. If you were using this strategy where you're not doing a monthly salary, typically at the end of the year, we will declare whatever that balance is as either a salary or a dividend. There are some exceptions where you're allowed to have what we refer to as a debit balance for 1 year. So you get to the end of the year and the director's advances is $100,000, and let's say we declare a salary of $80,000, then you have a $20,000 debit balance, meaning the money you took out, there's $20,000 more that you took out than you declared as salary. You're allowed to do that for 1 year, but when you get to the end of that second year, you have to repay that 20,000 plus anything else that you took out, and that's a hard and fast rule. There are some exceptions for longer term loans for like home loans and auto loans, but if it's not for a home or an auto loan, you would typically have to repay that. Like I said, at the maximum at the end of the 2 years. Usually we will only use that net debit balance in a very exceptional circumstance. So I hope that answers your question. And then, so we covered not saving enough money to pay sales tax and not paying your installments. Another big one is improper share structure and organizational structure. And this is really important to get right from the beginning, as well as, if you make any changes along the way. So first of all, the way we structure incorporations for our clients is with an end in mind. So we know that our goal is to help our clients organize their finances, create wealth, and transform wealth into a legacy. We look at corporations as being the tool to create that legacy. And usually the long-term goal is to get to the point of needing a holding company. And you would only need a holding company once you have enough money in retained earnings to invest, and that's generating income, which again, whole nother webinar on that. But if you have structured your companies properly, what we'll do is typically take that existing company that we set up at the beginning, that becomes the holding company, you incorporate a new company, and it's a relatively seamless and painless process that doesn't cost you very much. If you have not structured your company properly, then if you want to set up that holding company, it can become very expensive. We got to bring in tax lawyers, which are very expensive. They make, lawyers and accountants look cheap because they're basically the cost of both of us combined. And you need to have that specialties to get that corporate structure done properly. In addition, if you haven't set up the share structure properly at the beginning, as far as who the shareholders are, that can limit your ability to do dividends out to appropriate people. Now, I know, and some of you may be aware that the Liberals introduced something called TOSI, or tax on split income, a few years back, which does severely limit our ability to do dividends in the way that we used to, but we can still do dividends. And so we want to make sure that we have that proper share structure so that we can do dividends properly. And one of the things that people don't realize is if you have just one class of shares, common shares, and you give 50% of those common shares to the husband and 50% to the wife, well, that means that when you do a dividend to the common shares, whatever that dividend is, let's say it's 100,000, it has to be split equally based on the percentage of shares owned. So if it's 50-50, 50,000 would go to the husband and 50,000 would go to the spouse. And where that can become problematic is if you only have the one class of shares and you want to do a dividend, and it's split 50-50, but if the wife is not exempt from TOSI, she's going to pay the higher tax on that tax on split income. So it would really, erode our ability to do dividends as a tax strategy to the husband or the individual who owns the business, who's working in the business, who would be exempt from TOSI. So we want to make sure that we've got that share structure done properly from the beginning. Number 12, which almost should be number 1, is late tax filings. Not filing your tax return is the most common problem. Again, people do not enjoy dealing with taxes, do not enjoy, preparing bookkeepings. At least very few people do. And then as a result, they're late and they're now hit with interest and penalties, which can add up really significantly, because if you're late for multiple years, they can basically double the penalties. So it can be extremely expensive when you're late. For those of you who are not familiar with what your deadlines are, you've got your HST filing, which if you are on annual, it's 3 months after your year end. If you're quarterly or monthly, it's the first month after that quarter or month. And it's both the filing and the payment are due there. Corporate tax is a little bit funny. Again, for a small business, which is what our client bases are, you have 3 months after your year end that you have to pay by, which is funny because only our government would expect you to pay without expecting you to know what you're supposed to pay, because you don't have to have the actual tax filings to filed until 6 months after your year end. They want you to pay before they want you to file, which is, typical CRA fashion, backwards logic. But those are important deadlines that you do need to be aware of. And then finally, not hiring a professional. And that's where we can come in. We do offer free initial consultations. We do offer a turnkey solution with an in-house paralegal team to help set up your corporation, to make sure your corporation is structured properly. We do that industry benchmarking to look for missed opportunities, deductions that you may not have realized you could claim, as well as back all this up with audit representation protection, so that if you are audited, we're there to defend your rights and maximize those deductions. And then, of course, we've got sort of some unparalleled industry expertise when it comes to independent contractors. I don't think there's anyone across Canada who does more independent contractors and service-based businesses than ourselves. And as I said, we've been doing that since 1984 and done tens of thousands, if not hundreds of thousands, of corporate tax returns for service-based professionals. So if you are interested in learning more about our firm or getting in touch with us, feel free to scan that link with our mobile phone. Check out our website, where we've got lots of events every month, 2 to 3 a month. You can also follow us on any of our social media platforms, where we're putting out a ton of content. We'd love to hear from you if you've got suggestions on different content you'd like to see produced. And we've got an anonymous attendee saying, excellent session. I'm glad it was helpful. And if we do have any other questions coming up, feel free to post those now. I'll give this another minute or so before I do wrap up our session today. If there are any other additional questions that are coming through, please do let me know. And again, one of the other webinars I would highly recommend that goes along with this is top 10 strategies to reduce audit risk. Another great session. So we do have another question that's come through. Can golf green fees be paid by the company even though it is not a tax expense? So you can pay for it by the company, but it's going to then be considered a director's advance. It's like the company lending you money, because it's not, unfortunately, a deductible business expense. Bass says, thank you so much. Very informative session. Glad it was helpful for you. And if we don't have any other questions here, I'm going to wrap up our live now. And again, thank you guys for joining us. We'll be back in a few weeks with another great episode. Oh, we got one more sneaked in. Oh, no, just a thank you from Michael. You're more than welcome. Glad it was helpful for you. Bye for now, everybody.